Ladies and gentlemen, welcome back to the channel. You may have noticed that stocks are quote-unquote crashing today. But the fact of the matter is, if today would have happened a month ago, stocks would have been really green. What I mean by this is today is really not a bad day at all. We have a lot of good news to go over, but there's one scary thing that seemed to have happened today that is spooking Wall Street a little bit. It has to do with de minimis exemptions, but here's the funny part. 75% of this de minimis exemption ended in May. We've literally already felt the impacts of this. It's essentially a non-event, yet stocks are reacting to it. Why is that? And what do you need to know over the next 5 weeks that could make you a substantial amount of money? Basically, just don't even listen to the markets for the next 5 weeks. Like, if there was a time to go on vacation, like it's right now. Just turn off your portfolio for the next 5 weeks. You'll be just fine. Unless there is a change, in which there is not today. Today is bottom line an opportunity. But we will go over all of this in today's episode. If you're a little confused, well, stick around a while. We'll break it down. Hit that like button and subscribe to the channel if you have not done so already. Now, ladies and gentlemen, if you want to come join the trading community, check out that link down below in the description of this video. We are outperforming 98% of hedge funds and institutions with a year-to-date performance in this portfolio alone up 79%. Here's the secret sauce, okay? You could take this away from this video and it's forever applicable, or applicable is probably the better word. If everyone loves a stock, there's probably not much opportunity left in that stock. Like, are you going to get a 10x return off of the stock that everyone loves, knows, and invests in? Probably not. Far and few between does that happen. Where you find the real opportunities is in those areas that Wall Street really doesn't care about, they don't really know about, they're not paying attention to. Specifically, small cap AI stocks right now, I think are the cream of the crop when it comes to this strategy. You can find companies that are fantastic businesses. Little to no debt, growing at hundreds of percents a year, trading at a fraction of some of the well-known names that you know about, with great management teams, a bright future, that are heavily discounted. That is where the opportunity is. They are far and few between. Yes, that's true. But in this trading community, we are going out executing on these opportunities. Check it out, link down below in the description if you'd like to. Again, not a recommendation, not financial advice. You could lose all of your money. Who knows? Companies can be fraudulent and crazy shit can happen. So keep that in mind. I'm not a financial advisor. That is not a recommendation. I am documenting what I am doing. And please read the disclaimers and contact financial advice before making an investment decision. But I think our strategy is really unmatched on Wall Street because nobody else is doing this. Nobody else is going out, putting in the work, finding the areas of opportunity that are 1,000%ers or more. Nobody else is doing that. Not just hype trades. Like, we have 2 to 3 year time horizons on these investments. They're not just overnight, short squeezes, right? That's not the strategy either. So check it out. Link down below in the description of this video if you would like to read the disclaimers. And let's get into today's episode. Okay, so the first thing I want to tell you, let me speak to you, my fellow brethren, okay? None of this matters. Let's just be honest. As I've talked about before on this channel, the next 5-ish weeks are going to be on the weak side. This is not going to be a blistering rally over the next 5 weeks, okay? It's going to be slow. Any slight reason to sell stocks, Wall Street is going to take advantage of that. Why? Because you are in a period of seasonal weakness. That's the facts here, okay? So I don't really care what matters or what happens in the next 5 weeks. It doesn't matter, okay? As long as you're not seeing any material change, right? What does that mean? Well, if we start to see the economy is crashing, if we start to see that trade is not going in the right direction, that trade deals are getting further from being completed, which is not happening, but if that starts to happen, if we start to see inflation that is skyrocketing, or something like that, that would be something to pay attention to. But if we get one-off headlines like we're getting today, slight things here and there that tank markets, I don't care about that. I'm looking through that. That is essentially, let's use the words, quote unquote, transitory. Okay, because you're in the seasonal weakness. A piece of news that Wall Street really wouldn't have cared about 2 months ago could now be something that Wall Street cares about. And honestly, Wall Street didn't care about this news when it came out months ago, but they care about it today. Let me give you the news and what is driving stocks lower today. Okay, you might laugh at this. It says retail panic. What the end of the de minimis exemption means for brands across the globe. The de minimis exemption, which allowed shipments valued under $800 to enter the country duty-free, came to an end globally on Friday. The provision had been slated to end in July of 2027, but an executive order from President Trump eliminated it much sooner, giving businesses, customs officials, and postal services less time to prepare. Companies big and small have used the exemption to save money on digital fulfillment, and change could lead to higher prices. Small business owners on Etsy, eBay, and Shopify, for an example, relied on the provision to support their marketplace businesses. There's something big you need to know here. Okay, back in May, when stocks were freaking out, Trump ended the exemption for goods coming from China and Hong Kong. And on July 30th, he expanded the rollback to all countries, calling it a catastrophic loophole that's been used to evade tariffs and get unsafe or below market products into the US. Okay, so this de minimis exemption ended in China back in May. Where do you think a lot of the de minimis exemption was actually coming from to begin with? China. So the brunt of this has already been realized. A lot of the lower, cheaper price products, think of Shein, think of Temu. You know, a lot of people these days, if you know anyone that vapes, right? There's a lot of like vape products that are no longer available in the US because of tariffs, because of this de minimis exemption being withdrawn. Okay. You've already seen the effects of this. There's not a lot of de minimis products coming from, let's say, Europe, right? The euro is more expensive or valued higher than the dollar. Like there's just not much of that going on. Okay. So ending this now is like, again, we've already reacted to this, but because there's this seasonal weakness, it's giving people a reason to sell stocks. Okay, it says here the de minimis exemption had previously been slated to end in July 2027 as part of sweeping legislation passed by Congress, but Trump's executive order eliminated the provision much sooner, giving businesses, customs officials, and postal services less time to prepare. The ending of that under $800 per person per day rule from a global perspective is about to probably cause a bit of pandemonium, said Lindley Brown, a partner in the global trade division at accounting firm EY. Quote, there's a financial implication, there's an operational implication, and there's peer compliance, right? Like these have been informal entries. No one's really looked at them. It says already the sudden change has snarled supply chains from France to Singapore and led post offices across the world to temporarily suspend shipments to the US as they can ensure their systems are updated and able to comply with the new regulations. It says, quote, obviously it's a big change for operating models for companies, not just the Sheins and Temus, but for companies that have historically had e-com and brick and mortar stores. Okay, it says the end of de minimis could cost U.S. consumers at least $10.9 billion or $136 per family, according to a 2025 paper by Pablo Falbum and Amit Khandelwal for the National Bureau of Economic Research. This literally doesn't matter. Okay, sure, like, is there some impact? Of course. But it's so minimal. Like, is this going to be the thing that tips the economy over the edge? No. It says here a 2023 House report found more than 60% of de minimis shipments in 2021 came from China. Ding, 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 ding. Okay. As I said previously, you've already seen the vast majority of the impact of this. I would say, again, that was back in 2021. 60% of the de minimis shipments came from China. I would say, like, up until May, it was probably like 70 to 75% of the de minimis shipments came from China. Like, that percentage definitely went up since 2021. So you've already felt the brunt of this. Again, these kind of things you just kind of have to look through. You can't read too much into it because in terms of a market reaction, like, it makes no sense why Tesla's down 3.5% on this. It makes no sense why the NASDAQ of all indexes is down, 1.5% on this news. Like, it's seasonal weakness. That's it. Now, again, indexes are responding poorly today. The VIX is up 7.5%, okay? But there's two components to this. There is the hit on growth that you could see from de minimis being, withdrawn globally, okay? Again, this happened to China back in May. The brunt of this has already been materialized, okay? Important to remember. But to figure out if markets are more concerned about growth slowing down or about inflation implications from this, you got to look at other assets. First, bonds. Bond yields are up 1.5 basis points today. 10-year treasury yields are at 4.22%. Okay, they've come down and you're really not seeing a spike today. So what does that mean? It means that bond markets are not too concerned about this from an inflation perspective. Okay, oil is down 1% today. Oil you can kind of think of as an economic barometer. Okay, on any given day when news comes out that's affecting the markets, you can look at oil and get some kind of interpretation to what this actually means for the market. So for an example, oil down 1% today presumes a slightly weaker economy. Okay, so from a market's perspective, the markets are looking at this de minimis exemption, again, being thrown out for all countries, as it could hurt growth. Hence, oil down 1%. But it's not like a huge deal, okay? If this was really like a big deal for the economy and for growth, taking a hit, oil would be down more than 1%. So based on the bond reaction, based on the oil reaction, I can firmly say today's sell down is an overreaction to this news, to say the least, okay? Again, seasonals. You kind of have to really like pick and choose what news you give credit to or what's really important, because any slight bad news could just send the NASDAQ down 1% just because you're in a weak seasonal period. Now, we also had economic data that came out today. The economic data actually was fine, okay? Pretty much came in line with expectations. Core PCE month over month came in at 0.3%. That was the estimate. So you didn't come in on the low side, but you also didn't come in on the high side. Personal income month over month came in line with expectations at 0.4%. Personal spending month over month came in line with expectations at 0.5%. The goods trade balance came in at negative 103.6 billion. The estimate was 89.5 billion, so a slightly larger deficit than we were expecting. So that's definitely going to move estimates for GDP. It actually moved estimates up for GDP. Okay. So yesterday, the estimate was 2.2%. Today, the estimate is 3.5%. Okay. Now, this is important to point out, and somebody in the trading group also pointed this out today, it says here, the nowcast of third quarter real personal consumption expenditures growth and second quarter real gross private domestic investment growth increased from 2.2% and 4.4%, respectively, to 2.3% and 6.1%. This second number, very important, okay? And there was a lot of questions today what this actually means in like simple terms, okay? The second quarter real gross private domestic investment growth. It increased from 4.4% to 6.1%. What this means, to simply put it, is companies are investing, okay? Domestic investment growth. Just think about that, okay? Private domestic investment growth. So there's a lot of things that go into a GDP report, okay? The goods trades balance, as an example, incomes and personal spending and all of this, okay? But one of the best metrics to look at is, are companies investing? Okay? And the answer is they are investing aggressively. Why is that important? Well, I'm actually watching the drama documentary on Netflix right now called Titans of Wall Street. Like, from the 1800s through the early 1900s, it's a fascinating like short series on like JP Morgan and Goldman Sachs and some of the feuds they were having and the starting of Wall Street firms, okay? And like some of those panics, like the panic of 1907 and, you know, Great Depression even, and some of the earlier panics, what it did was it stopped that domestic investment. Okay, some of those panics back in the day, and that's where you get larger problems. Okay, I bring this up because no matter what the data says for goods trades balance or this metric or that metric, what's really important are companies continuing to invest or not, and they are. Okay, so yes, GDP went up a lot today. What's also interesting is with this de minimis news today, the odds of rate cuts actually went up today. Because people are like, oh my gosh, is this going to hurt growth? Okay, well, it's not. Companies are investing aggressively in America right now. So the odds of rate cuts yesterday was 82.9%. It went up to 84.4% today. Okay, so today you actually, in my view, like, stocks should probably be trading higher today. Okay? You probably shouldn't have a red day today. So, again, it's seasonals. There's some weird shit that goes on during this time of the year. People are out on vacations. Like, nobody's really in the office today. Like, interns maybe. Sure. But, like, is Wall Street really paying attention to the markets today? No. That private domestic investment growth number also says, again, companies are investing in America aggressively, but what it means to me is down the line, growth is going to improve and get even better. Because if you're investing today, you're not expecting to see a return today 9 times out of 10, right? You're investing for the future. So that likely just means to me, you're going to see a lot more investing and a lot more growth into the future. One of those areas in which you're seeing a lot of that growth is AI. And that is an opportunity that you do not want to miss. That's why we started the trading group, so we do not miss it. Again, if you want to join it, check out that link down below in the description of this video. And again, I just want to say that markets being able to take a red day, I think, is actually a very healthy thing. Like, it still shows there's a lot of bears out there, that people are not overly optimistic that they will look through everything. Okay, now, whether they react correctly or not, that's another question. Okay, is the NASDAQ being down almost 1.5% today the correct reaction to the news today? Absolutely not. Stocks should be green today. Again, Wall Street's not very smart. So stocks are moving lower. But that's a good thing, okay? That is a great thing. I love to see the markets that jump to the bearish conclusion first, that don't even look into the data. Okay? Because if Wall Street knew what I was telling you, they would be buying stocks today. So this is a sign that this market has a lot of legs. Okay? And again, the next 5 or 6 weeks are going to be choppy. Any slight piece of bad news is going to be over amplified. Okay? But it really reaffirms to me that into the end of this year, you're going to have a very aggressive rally to the upside, especially in small caps, AI, financials, okay? Not necessarily the Mag 7 in my view. And then into 2026, you're going to have a very strong market as well. Now, here on the day today, the percent of stocks trading above their 50-day moving average coming in a little bit lower today. But in fact, like the NASDAQ being down, almost 1.5%. Today is actually not a terrible day. You're at about 65% of stocks trading above their 50-day moving average. You're only down 1% today on this metric. So it's not like it's a bloodbath out there. But there are some definitely, concentrated red stocks. Now, the CNN Fear and Greed Index yesterday was 66. Today, it is 64. So moving down a little bit. Market momentum is neutral. Stock price strength, extreme greed. Stock price breadth is greed. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is greed. And junk bond demand currently in extreme greed. We could see the most recent AI investor sentiment survey did show bearish investors fell from 44.8% to 39.4%. Neutral investors rose from 24.4% to 26.0%, and bullish investors rose from 30.8% to 34.6%. But again, I will point out, you still have about 5% more bears than bulls on this metric. Normally, the historical average is about 7.5% higher or 6.5% higher on the bull side versus the bear side. So you still need to go up like 12%, 11% on the bull side just to get to a historical average. Not like a super bull market, not where everyone's all bulled up, but just to get to like an average. Okay. There's a lot of bears out there. And the more bears you have, the longer the rally lasts, the higher the markets go. I know it's contrarian as hell, but that's how these things work. So again, just to be really clear with all of this, during the next 5 weeks or so, you really have to think logically about this market. Like, not every red day or even substantial red day, like today, NASDAQ down over 1%, is logical, okay? The algorithms are programmed to sell stocks over the next 5 weeks. That any sign of elevated risk to de-risk, okay? That's how Wall Street operates. They operate based on risk. Like, for an example, with SPACs, you know why SPACs do poorly after they SPAC? Most of it has to do with hedge funds and institutions that their algorithms are programmed don't touch a SPAC until at least a year after it de-SPACs, right? Because the historical performance is so bad. September, pretty much the same way. Like, people don't really want to touch stocks because the historical performance in September is like over -1%. And some years, September is way worse than that. Things start to work in your favor again October, November, December. So what really matters is the economy growing? Yes. Like, look at the 6.2% private domestic investment growth number today. That was crazy. That's huge, okay? The economy is doing just fine. The de minimis exemption today that ended is like we already felt that back in May. Is that going to hurt earnings? No. Is that going to hurt the economy at this point? No. Stocks are just reacting because it's this period of seasonal weakness. So my point is, there could be news, though, that is worth reacting to. Again, if the economy all of a sudden weakens, which there's no sign of, but if that happens, or if inflation becomes even a larger problem, or if Trump says some wild shit about trade and trade deals start to get kind of walked back, Those would be things to react to. But this, it's an opportunity. Everyone's away on vacations. Algorithms are running the show here. And algorithms, they're not very smart. So today is really just a fool's kind of day. Because if the same day would have happened a month ago, stocks would have been really green today. Okay, so hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community if you guys would like to come join it. Again, not a financial advisor, not a recommendation. You could lose all of your money if you blindly copy trades that other individuals make. But in that community, we are, again, going out finding small cap AI stocks before Wall Street does, because you don't want to buy the hype. You don't want to buy the stocks that everyone loves. Sure. Are they quality businesses? Probably. But the opportunity is mostly gone if everyone already knows about it. So we're going out finding those hidden gems before Wall Street knows about it. There's one stock in particular I have over $100,000 invested in that I think is going to make well over $1 million over the next 2-ish years. Hey, just my opinion. Let me know your thoughts again down below in the comment section. Have a great Labor Day. I almost said Memorial Day. Labor Day weekend, guys, and I will see you in the next one.